Have you ever thought about a strange question? It's all $1, so why can it only buy you a small cup of coffee in the US, but get you a steaming bowl of pho in Vietnam? Why is that red 100 yuan note in your hand and that green $100 bill, both just money, so vastly different in value? What's pulling the strings behind the scenes? Is it because some countries print more money? Or are some currencies just born more valuable than others? Hey friends, welcome to Liobing. Today, we're not going to talk about complex charts and economic models. We're going to play a game where we treat countries as corporations. To completely understand why there's a never-ending value war between different currencies. The Nation Inc. First, forget everything you think you know about countries. From now on, I want you to imagine every single nation as a publicly traded company competing in the massive marketplace that is planet Earth. The United States is America Inc. China is the China Group. Japan is Japan Corp. And what about the currencies each country issues, like the US dollar, the Chinese yuan, the Japanese yen? Think of it as the stock issued by that company. If you hold Chinese yuan, it's like you own shares in the China Group. If you have US dollars in your wallet, it means you're a small shareholder in America Inc. Okay, you've accepted the rules of the game, right? So here's the question: what determines the price of a company's stock? The answer is simple: the company's performance and the market's confidence in it. Act 2. The 4 pillars of value. This brings us to our core idea today. The value of a country's currency, its stock price, is mainly supported by 4 things. First, and most important, the company's fundamentals or nation's economic strength. If a company profitable year after year, launching new products one after another, with customers all over the world, its stock price will surely soar, right? It's the same for countries. When a country's GDP, gross domestic product, is consistently growing, its tech innovation is breaking new ground, its exports are in high demand globally, and its unemployment rate is low, it shows that Nation Inc. is performing exceptionally well. Global investors will feel that holding your stock currency is a safe bet with future potential, so they rush to buy it. And with higher demand, your currency's value, the exchange rate, naturally rises. This is why the currencies of economically strong nations are typically worth more. The second pillar is the dividend for shareholders of nations' interest rates. Imagine you're putting money in a bank. You'd look for the highest interest rate, wouldn't you? It's the same for countries. The interest rate set by a country is like the annual dividend that the company promises to its shareholders. If America Inc.'s Federal Reserve announces an interest rate hike, raising the dividend to, say, a 5% annual return. Meanwhile, neighboring Japan Corp. keeps its interest rate at 0, offering no dividend at all. As a smart global investor, where would you put your money? In America, of course. Hot money from all over the world will flood into the United States, to be converted into US dollars to enjoy these high dividends. With so many people trying to buy dollars, the stock price of the dollar goes up, doesn't it? This is why the whole world trembles whenever the Fed even hints at raising rates. The third pillar, the number of shares issued of the money supply. Imagine a profitable company that suddenly decides to issue a massive amount of new stock, doubling or tripling its total shares. As an existing shareholder, your stock would become less valuable, right? Because your stake has been diluted. It's the same principle with currency. If a country's central bank starts printing money like crazy, engaging in quantitative easing, and the amount of money in circulation suddenly multiplies, the purchasing power of each unit of currency will fall. This is what we call inflation. When there's too much money, it's not worth as much, and its stock price, the exchange rate, will naturally decline. The final and most abstract pillar, the company's reputation, the nation's political stability and credit. Would you invest in a company whose CEO changes every other day and might go bankrupt next month? Of course not. It's the same with countries. If a country is politically unstable, constantly at war, or has an unreliable government, global investors will see it as too risky. They will immediately sell off your stock currency and flee. This can cause the currency's stock price to collapse instantly. Therefore, a stable and predictable political environment is the invisible anchor of a currency's value. Act 3. The average person's value war. Okay, at this point, you might be thinking, this is all a game for countries and Wall Street elites. What does it have to do with me? It has everything to do with you. The fluctuation of currency values is like an invisible hand, quietly affecting your wallet. If you love to travel abroad, a stronger yuan means your money can be exchanged for more foreign currency. You can stay in better hotels, eat at fancier restaurants, and shop to your heart's content. If you're a business owner who exports goods, a stronger yuan is your worst nightmare. Your products become more expensive for foreigners, making them less competitive, and your orders might fly away to Vietnam or India. On the other hand, if the yuan weakens, traveling abroad becomes more expensive. But exporters are overjoyed because their goods are cheaper and sell better overseas. See, it's a war without smoke. Every country is like a chess player, trying to find the perfect exchange rate balance point that benefits economic growth, controls inflation, and promotes exports. Conclusion and outlook. So, back to our initial question, why do different countries' currencies have different values? Because a currency isn't just a piece of paper, it's a stock that measures a nation's overall strength. Behind its value lies a combination of the country's economic growth, interest rate policies, money supply, and global credibility. It's not static. It's a result that is being voted on every single second by millions of investors with real money in the giant global marketplace. So what about the future? With the rise of digital currencies and the ever-shifting global economic landscape, how will this war of currency values evolve? Will the dominance of America Inc. be challenged? What will be the future stock price of the China Group's yuan on the global stage? There are no definitive answers to these questions. But by understanding the rules of the Nation Inc. game we played today, you've at least gained a map to observe the world of tomorrow. Thanks for watching Liobing. If you found today's analogy interesting, don't forget to like and subscribe. See you next time for something even more exciting.